Many real estate investors are missing one of the biggest tax benefits available to them, depreciation. In this video, I'm going to show you exactly how depreciation works for rental property and how it can save you thousands in taxes every year. Some investors legally pay little to no tax on their rental income, and depreciation is a big reason why. Depreciation is a tax deduction that allows you to write off the cost of your rental property over time. Even though your property may actually be going up in value, the IRS lets you treat the building as if it's wearing out. And that creates a non-cash expense, which means tax savings without actually spending money. And then the 27.5-year rule. For residential rental property, the IRS requires you to depreciate the building over 27.5 years. That means you take the value of the building, not the land, and spread it out evenly over 27.5 years. Each year, you get a portion of that value as a deduction on your tax return. And here's a key rule: land is not depreciable. Only the building can be depreciated. So when you buy a property, you need to separate the purchase price between land and building. Typically, you can find this breakdown on your property tax assessment or use a reasonable allocation. Let's look at a simple example. Let's say let's say you buy a rental property for $300,000, and let's say $60,000 is allocated to land and $240,000 is allocated to the building. The $240,000 is what you'll use for depreciation. To calculate annual depreciation, you take the building value and divide it by 27.5, for 27.5 years. So in this example, 240,000 divided by 27.5 equals about $8,727 per year. That's a deduction you can take every single year. Now here's where it gets powerful. If you're in, say, a 24% tax bracket, that $8,727 deduction could save you around $2,000 per year in taxes. And again, this is a non-cash expense. You're not actually paying that money, you're just reducing your taxable income. And it doesn't stop with just a building. You can also depreciate things like appliances, flooring, HVAC systems, and other improvements. Some of these can even be depreciated faster using strategies like cost segregation, but that's a more advanced topic. The key takeaway is this: depreciation is one of the biggest tax advantages of owning rental property. It allows you to reduce your taxable income, often significantly, while your property is actually increasing in value. If you're not taking full advantage of depreciation, you're likely overpaying in taxes. If you want a simple checklist of tax deductions for rental property owners, check out the link in the description. And if you found this helpful, make sure to like and subscribe for more real estate tax strategies.